So good afternoon to all of you. I will speak in English, even though I'm sure that many of you are very happy to be in France and could be speaking French. We have this concluding panel entitled Debt Sustainability in a Warming World, New Instruments. And we will be here discussing how debt and climate can go together or can go against each other, and how the financing instruments we have can serve potentially the two challenges we have in front of us jointly, and trying not to oppose in the way we build financial instruments, the two topics. Maybe just as an introduction, as we are in Paris, to remind you that 1 year ago, the President Macron organized a global conference entitled the New Global Financing Pact Conference that led to the Paris Pact for People and Planet, the 4P, that are 4 principles to make it easy to remind and remember. The first principle is to say that we should stop opposing, fighting for economic and human development and fighting against climate change. Because the more we oppose the two concepts, the less effective we are. To say it simply, if people die of hunger under windmills, we have not achieved what we should be doing. And in return, if we develop countries and rich human capital with coal power plants, we are also not achieving what we should be achieving. The second principle is to say that these climate and development and biodiversity and human capital plans should be the choices of countries, meaning it's not in Washington, London, or Paris that we decide. And this is a very strong choice because many stakeholders might have different views initially. The third is to say that we need to reform and revamp and reinforce the role of MDBs and public instruments, not only by mobilizing more public money. And today the OECD just released that at last we managed to go above the 100 billion for climate finance that were asked as part of the Paris Agreement. So this is good news, but we know it's largely below what is needed. So we need more public money. And the fourth principle is that also we need more private money mobilized by public instruments, that we need to put private money at work. At the moment, there is a target of 1 for 1 for MDBs. So of every $1 mobilized and put forward by the World Bank and others, there is at least $1 of private capital. At the moment, the best computation we have is that we are more rather at 0.3 to 0.4 of private money to $1 of public money. So we need to multiply at least by 3 to 4 the private capital we mobilize. So in this session, we will go at the heart of the first principle. If we say that we should not oppose development and climate, that we should not oppose what we do for economic prosperity to what we do to fight climate change, then we need to look at the heart of the question, which is public finances and debt sustainability. Because at the very moment we speak, a trend that was historically present in last years changed. In the last decade, emerging and developing countries were net inflow positive recipients of global money, meaning more money was entering than money was going out. And this led to a number of investment, maybe not exactly where some people should have thought they should have been going, but investment was there. In the last 3 to 4 years after COVID, and I see lots of faces in the room that documented it very precisely, and FinDevLab is one of them, we see a negative net inflow to emerging and developing economies, meaning that at the current moment, at the time where we say we need more money to invest for economic development, where we need more money to invest for climate, emerging and developing economies are being net funders of the rest of the world. But who is the rest of the world? It's OECD countries. So we are in a moment where it's not OECD countries financing emerging and developing economies. It's not those rich in savings financing those rich in investment needs. It's those having a lot of debt, paying that debt, but not receiving any additional money to invest for economic development. So at the heart of our problem is that if we think about debt sustainability in a warming world, well, emerging and developing economies do not have, at the very moment we speak, any financial leeway to invest to fight climate change, because all they have is to pay their external creditors. So here we are, and I'm very proud to have with us a group of very experienced, seasoned, and I would say to the point experts in different capacities that I will be introducing in sequence. And to start, I will ask David Ndii, who is currently working with the Kenyan government in a very important role as I understand, economist or chief economist. And David, I lost your page, but you're here. And you will explain how you are, as President's Council of Economic Advisor to President Ruto, living live what we just described. Maybe tell us what happened last year. President Ruto was one of the main supporter of this Paris New Global Financing Pact conference, and how in Kenya this climate and debt issue has been managed, but is also a challenge for you.
Thank you very much. Working?
Yes.
Can you hear me? Okay, thank you very much. And thank you very much to the Dev Lab for inviting me to share the Kenyan experience. I think I was here a couple of months ago deliberating on the subject, and I was also here during the Paris Summit. So we've been sort of live, so to speak, on this subject. What I want to do is share briefly what that experience is like of really being in the engine room of grappling with this convergence of macroeconomic shocks and extreme weather events in real time, and in the context of that vulnerability. When we were here a year ago,
I'm being told to use this one.
when we were here a year ago, I think that's better, yes. The question that actually loomed largest among the frontier market investors was whether Kenya was going to default. Why? Because we had the largest maturity in 24 this year, which is due end of June, and a $2 billion maturity, which is among the sort of countries at our level was the largest. Of course, the markets were closed at the time. And so you can imagine since then, I have met more sovereign debt consultants that I want to do for the rest of my life.
And many are here,
Yes.
and they're very proud.
I don't want to name names, but and the more I have seen more liability management proposals than I care about. So what that was a big issue, and that constrained even many other aspects of what you can do in terms of macro management. There are many other shocks. There was commodity price shocks, and then what that did is it fed into a kind of a speculative bubble on the currency. And that also now complicates even your repayments and your monetary policy and a whole lot of things. So what we tried to do to at least restore some confidence was to organize a multilateral financing backstop. And that meant activating exceptional access facility with the IMF, backed by a big development DPO, whatever the acronym stands for, with the World Bank, a couple of things, that even in the event that we were not able to refinance in the market, we would actually be able to pay off the maturity using multilateral resources. But that, of course, meant, and the exceptional access comes with very deep structural benchmarks, which is quite a paradox because the structural benchmarks, the structural performance benchmarks are not actually based on the reason why we thought traditionally the exceptional access is predicated on the assumption that you have a sort of structural economic challenges that you need to address with deep reforms. This is not the case. The only reason is because of market, sort of this market sort of start-stop market behavior. It's a liquidity insurance. But that liquidity insurance requires you to sort of do structural, implement structure, because I think the fund has yet to adapt to the fact that these are sort of external shock-driven thing. It's actually not got to do with structural. Anyway.
It's not, I cut you here.
Yeah.
This is not anyway. This is a big problem. Because if the International Monetary Fund is not fit for purpose to deal with extreme weather situations, it's not just Kenya. It was Pakistan the year before, and there are many other countries. So this is why we are pushing a reform of the mandate. Because as you say, it's not a anecdotal remark. It's a very important remark.
We are living that need to reform the mandate. Yes, the instruments, the lending instruments of the IMF. And I'll mention another one shortly. So, but at any rate, what happened is that was the arrangement. It gave us a bit of reassurance. The market wasn't persuaded. It kept pushing. But in January, early in the year, there was indication by the US that rates would be coming down initially. And what we had done was we had organized and said, if the market opens, we will go into the market. So we had our paperwork in the drawer and said, if there's a market opportunity between, and then our preference is to refinance during the market. So in January, there was a bit of a indication that the US rates would come down. And we saw movement. People in the EM sort of investors started telling us that there is sort of a bit more positivity about sort of taking. So within, I think, early February, there was 2 other countries that decided to go to the market, Cote d'Ivoire and Benin. We joined a lot. So we went into the market, raised $1.5 billion, and bought back the rest. We did the buyback. So as of now, we only have $500 million left, which is due in June, and that will be able to pay off from what the World Bank's finance. So that's the story. But so we kind of dodged that bullet, but we're not out of the woods. We're not out of the woods because if you look at our maturity profile for the next 3-4 years, I think it's a repeat performance every year. So I think the biggest payment, although you've seen a bit of unwinding of that uncertainty, in the meantime, we just emerged from a very severe drought, probably the most severe drought in 50 years. So,
what's the yield on the new debt? Isn't it quite high?
I'm coming to that. So the new debt is shorter maturity because once you look at the market, sort of did your book building. The old bond was 10 years with coupons, I think 6.5 to 7. The new debt is 10.5. I think the yields have come down to about 9. The average tenure is 6 years because you got sort of a structured sort of settlement in 3 years. I think 5, 6, and 7. But just to give the import of that is that if you look at the coupon on the old bond, $2 billion, the interest was about 130 on $2 billion. Coupon on the 1.5 is 155 odd. So coupon on the 1.5 is 15% more than on the old buyer. Of course, the tenure is also shorter.
But to conclude, it means that at the very moment we speak, Kenya has not gained any investment margin. You have not just refinanced your debt, but you don't have any dollar in addition to invest in energy, to invest in roads, to invest in education. So you are just talking about not being in default, but you have not gained anything for the real people and the real economy. And
absolutely zero. In the meantime, this year, coming out of the drought, we've had very most severe floods again in probably since, not even since the last El Nino, even before that. So we have about $500 million of infrastructure damage that you need to repair. So it's not just about the fact that you don't have money to invest, but the fact that the weather shocks are diverting resources that you would even invest into fast response, emergency response. I mean, if you have to do emergency response, you still have more than about 10,000 displaced people internally, plus then you have to divert money to recovery and rebuilding of that infrastructure. If you go further south, where you've had cyclones, non-stop cyclones for the last sort of 4 years, again, just 2 countries down the road is a severe drought. So
I will maybe, I think, make the link now, if you are finished, to our speaker, Frederico Gilsander from the World Bank, because I think what is being said here is precisely at the heart of the reform agenda that President Ajay Banga also wants to pursue at the bank, is how you, with your instruments, you can better include climate risks in the way you promote your instruments of loans, and also how in the debt treatment and the loans you provide, you can better assist countries to gain leeway to invest, but also to gain instruments to face shocks. And then we will go to those of you who are working on climate debt resilient clauses, which are precisely designed for these type of situations. So there is a mic here, Frederico. Yes, Steen from the World Bank, and maybe I'll let you give precisely your role at the bank, because you do many things. How do you see exactly the example from Kenya, which I think is at the heart of the challenges we have, not just in Kenya, but all over the emerging and developing economies?
Thank you very much for the question. And I took this microphone because it's the one that is proven to work. So, so thank you very much. I mean, what we have been thinking a lot about at the World Bank is how to create, the group that I lead looks at debt policy issues. So some of the challenges that countries are facing with debt sustainability, but also we work a lot with debt managers and reinforcing debt management as an important way to address some of these debt vulnerabilities in the long term. So one of the areas that we're working on very hard right now is on something that I like to call climate smart debt management. And climate smart debt management has two components to it. One is on the instruments. What are the instruments that countries and the debt managers in particular have available to finance their investments in mitigation, in adaptation, in building resilience for their countries, right? So clearly, when you talk about the floods, I think that we are more and more aware of the very high investment needs for improving the resilience of existing infrastructure, in addition to rebuilding when the infrastructure is damaged. So for that, maybe I will just mention, we talk about green bonds and blue bonds, but the World Bank has recently been working on what we call the KPI bonds. So Uruguay, they have among their nationally defined contribution, their plans to reducing emissions, to reduce the emissions from cattle, which is a very important industry, of course, in Uruguay. So the World Bank is helping them structure a bond with the help of one of the World Bank's trust funds, where the interest rate that Uruguay pays actually comes down if they meet their emission reduction targets. So that's just one example of one instrument that the World Bank is working on. But basically, from coming back to this framing of debt management, the debt managers need to become aware and they need to understand these instruments. And they also need to lobby for use of these instruments, because from the point of view of debt managers, the reason that you use these instruments is because they mean more financing and with the promise of lower cost financing for investments, which we all agree are very important and which are not contradictory between the development and the climate objectives, especially for the poorest countries. Then the other pillar of this is risk management. And I think that this was the core of your question. And this is indeed something that President Banga has emphasized by expanding our kind of crisis response toolkit. So again, looking at it from the perspective of debt managers, how can the debt portfolio become more resilient to climate shocks, right? Because part of what climate change is bringing is more frequent, more severe shocks. The flood, which is the largest in 50 years, or the drought that is the largest in 50 years, those things, unfortunately, are likely to continue to come. So we have introduced the climate resilient debt clauses in the World Bank financing. So that's one tool that can be useful to help reduce the outflows from countries that are hit by climate shocks, especially for the most vulnerable countries. The World Bank is trying to expand the use of its CAT DDOs. Those are contingent loans that actually have a fairly low threshold for being accessed. So you do not have to have at the time that you approve the CAT DDO, it's like a budget support operation, but it's not drawn on immediately. It's drawn on based on a declaration of emergency. So it doesn't require you to have a hurricane of at least category X plus Y. It's not parametric in the technical language. It is something that is based on a declaration of national emergency. So the amounts here may not be sufficiently large for very large emergencies, but again, as part of an overall kind of toolkit, these CAT DDOs can be very important, and we feel that it's useful for debt managers to actually acquire more and more of that, because that actually gives you immediate cash when a disaster hits, and it's a relatively easy process.
Can you name some countries who did already some agreements of, as you said, pre-contingency financing schemes?
So this is an instrument that we have a lot of experience. So I know that in the Pacific, I can't think right now on Jamaica probably has one in the Caribbean. This is an instrument that has seen good take-up. The IDB also offers their own version of CAT DDOs. But the advantage here is that it's really based on a declaration of national emergency and quick access to the funds at a time when it's needed. There's also catastrophe bonds, which is more like insurance. The DDO is a loan, right? So it's basically a contingent loan. CAT bonds actually pay off money, which is just insurance. You don't have to repay that. And they cover larger risks, and they're going to be more based on parametric risks, which makes it harder to cover things like floods. Floods are one of the very challenging natural disasters that we have to do more work to. How do we model them so that we can actually transfer some of these risks to the market, which is something that you can do with the CAT bonds. And here we see maybe an area where there is something missing, and I want to invite, maybe something that we can work together on, is that for some countries, their access to local bond markets may be restricted if they actually face a disaster, right? So a country that may have good macroeconomic policies, they are hit by a disaster, they have a regular based auction, but then the market may not be there, or they might demand a premium because there's a lot of uncertainty in the immediate aftermath of the disaster. The south of Brazil is also experiencing incredible floods, and you don't know when the flood is going to subside. So that can actually affect the market access. And it would be useful to think about creating some kind of contingent lending facility, which is actually parametric, but which is larger. And when we actually manage to transfer some of these risks to the market, to create yet another tool in the toolbox for climate resilient debt management.
So as part of the 4P and this Paris Pact for People and Planet, we are like a umbrella for many global coalition. And there is one of the many coalitions we support, which is about climate debt resilience clauses. I never know in which order we have to say it. But the idea is a bit the reverse. It's not to lend more money, but is to halt the payment after a national emergency situation. Is not to ask more money, but is to say for a 1 to 2 year period, you don't repay your interest, you don't repay your coupons to people who understand that they have larger chances to be finally well repaid if for a short amount of time, they put the country in a capacity to use all the fiscal space they have to rebuild, to repair, to put the economy back on track, and then to be back on a normal pace. France, the UK, Barbados, and others have joined this coalition. And typically France now, every loan we do as part of the French Development Agency, AFD, they now have these climate debt resilience clauses. The UK is doing now the same. And we feel it's an instrument of not generating more debt when you have a crisis, but it's to making a pause on your payment. So with this, I will pass the floor to Avinash. Avinash, we've been working a lot with a country very affected by these type of events, named Barbados, and as part of the Bridgetown initiative led by Prime Minister Mia Mottley. And I was willing to ask you how, from this notion that you know very well, how from now your role at the IDB, how do you see these innovative debt instruments, which are not about having access in times of crisis to markets, but is how do we make a pre-deal with the creditors that if you are in a climate shock, if you are Kenya, this 500 million you need, the best way to find them is to pause your payment to external debt service.
And you know, the history of this starts off with us in a debt restructuring and renegotiating our debt. And our advisors are White Oak, who did the first hurricane clauses in the Seychelles, I think it was. Jim, you were on the legal team in Grenada, St. Kitts, and we ended up doing it as well. We just threw it into our exchange bonds. The private creditors sent them back without the clauses. We put them back in and sent it off to them, and they came back without the clauses. By the third time, they just given up repeating this because they thought, what are these things anyway? So we got them in, and we had accidentally become the world's biggest issuer of sovereign bonds with these clauses in them. And then about a year later, we're thinking about the challenges of climate change and realize that climate change has become an uninsurable event. People are always trying to throw at climate vulnerable countries magical solutions that doesn't cost them any money. And they've been trying to throw at us insurance. But insurance works when you can spread the risk over time, or you can spread the risk across different risks. And climate change is the exact opposite. It's a rising probability of a rising loss with rising frequency. It's rising correlations. If you try to insure it, you'd go bust very quickly. And with parametric insurance, we're the first region to have a regional pooled parametric insurance. We found that we were paying increasing premiums and getting lower and lower payouts. So it occurred to us that this thing we'd accidentally put into our bonds was actually really powerful. These hurricane clauses, then they became natural disaster clauses, then climate resilient debt clauses, CRDCs. I don't know why they picked that name, but one of the things I've learned about campaigning and changing policy is don't make a big deal about the name. So CRDCs is what they've become. And if every developing country had them during COVID, because we added pandemics to our CRDCs, so they're not really just climate, they're resilient clauses. If every developing country had them, it would have released $1 trillion of liquidity during the pandemics. And I think the scale is important here because firstly, it's NPV neutral. The creditor is not taking a bet on climate change. We can only activate this clause twice. It gives us tremendous liquidity. There is no instrument out there that gives us anywhere near the same amount of liquidity. We get 17% of our GDP. Previously, the World Bank and others, IDB, they'd offered us these types of instruments that gave us 2% of GDP. Great, but when you're a small island developing state, you face wipeout risk. You face storms are bigger than the islands. So you need something that gives you tremendous amount of liquidity to respond. So that's really where they are now. Ajay Banga picked it up very quickly, as did Ilan Goldfein at the IDB. And now it's become wildfire, helped a lot by the Paris Pact, and Amelie's played a great role in the Paris Pact amongst the public sector, but we never imagined it would be a public sector thing. We'd negotiated with our private creditors so they would accept the sovereign bond issuing, the sovereign issuing the bond, that the private creditor would be happy to hold them. And that's the next stage we need to do with these bonds. We need to make it socialized and normalized amongst private creditors. And that would change the international financial system, make it much more able to deal with shocks. The final point I want to make, Amélie, is that I think the big change that's occurred in the past 2 years, because we've now got momentum on climate finance, the work you're doing and other people are doing, is a realization of scale. Before, we had all kinds of clever ideas. Human beings are very clever, lots of creativity. None of it would move the needle. We now need a different set of ideas, like these climate resilient instruments. But we need to shift. And Vera, who's up there, her report showed that we need $2.4 trillion per year in developing countries. Amélie's pointed out it's a negative flow today. It needs to be a positive 2.4 trillion just for climate. And we need to get there by breaking it down from revenues, savings, and costs. And when if you have time later, I can explain how we might use that framework to get to the 2.4 trillion.
Indeed, Vera has worked with us a lot on many things. And one is about the private sector, because many of what we're talking is not, again, as I framed it initially, cannot be dealt by only public instruments, public funds, even though we need to mobilize more the public and we need to make the public money more effective. And this is for sure. And it should not be seen that if we talk about the private, we'll just forget the public.
Well, the only way you get to 2.4 trillion is by engaging grants from the public sector, from the donors, OECD donors, the borrowing from World Bank and IDB and others at low cost with rewards, etc., and the private sector,
yeah,
which is going to be about 70% of that number,
exactly,
about $2 trillion.
So this is for Vera a bit later. But before, I would like to ask Bright Simons, because you looked at the social and technical evaluation of development reforms, and you looked at these climate debt related instruments. I think you now have a quite good vision of the next steps, also regarding governance, capacity building, and how we can reach speed, scale, and largest impact to protect. Again, I think the case of Kenya is very telling. Maybe what's your view on this? And I maybe let you introduce precisely what you do now, so as I'm not wrong in my presentation.
No problem. Thank you, Amélie. So I'm the civil society. I won't say token, but I'm a civil society rep on here. So my perspective is going to be significantly different. I'm coming at it from more bottom up. It started for us around 2021. My native country, Ghana, lost access to the international capital markets. And all of a sudden, green finance became really big. So the minister, rushed to a policy. We started to explore all the different alternative ways of raising money for the country. One of the things that became, fascinating for those of us in the activist community, the policy community, was to try and see whether we could understand the nature of these instruments, these alternative instruments, a bit better, and then compare them to what we've been using before and our capacity as a country to adopt them using the experience of the classical instruments. So we learned a lot more about these contingency mechanisms, these activated mechanisms that are based on sometimes government performance, and in some instances, you can say it's random. So you think of like GDP-linked bonds or things like that. Now, the interesting thing that we found was that for a lot of the climate-linked instruments that were available, mitigation was a bigger deal than adaptation for the most part. So essentially, you borrow money from investors and you say, look, we will use part of that money to address the emissions. And the feeling, I think that fundamental economic logic there is that the benefits of, say, reducing emissions or taking actions that significantly curtail emissions are global. The benefits are global, but the costs are local. So we need to find a way in which the positive externalities are internalized. Somebody has to pay for it. So the rest of the world somehow have to figure out a way to pay us for taking actions that curtail emissions that benefit the rest of the globe. So if you think of it that way, it becomes very clear that this embedded option must have value of some kind. And investors if you design it right, will be able to price it right, and that additional value could accrue to the benefit of whoever is issuing it. I mean, that's at least theoretically. I guess it gets very complex, but at least theoretically. So we said, okay, if that is the case, then these emissions, the curtailment of these emissions must really happen. Because if it doesn't, then, you know, all of this theory falls apart. So if you say, for instance, that I'm going to apply land, you know, I'm going to modify my land use in ways that allow me to absorb carbon from the atmosphere to 200 tons of carbon, let's say. It's fine if you do 110 tons of carbon and the rest of it. But what if, in actual fact, because of poor design, you end up putting more methane, a much more potent greenhouse gas in the air? So we have to assume that there is a scientific as well as a kind of forensic element to making sure that these mechanisms actually work. So starting from that point of view, we said, okay, it requires local verification capacity because most of these projects will be national. So essentially, if I'm selling this to the rest of the world as a means to reduce emissions, we have to have the capacity to really measure the project, monitor it, and make sure that that is happening. So we said, how well do we do with classical projects? Because that will, in a way, tell us whether or not these climate-linked projects will succeed. So we took a look at the entire World Bank portfolio in Ghana, and then the portfolio of a number of other multilaterals and other funders. And we had a very simple methodology. Go for the best performing projects, best performing in terms of disbursement rate, best performing in terms of rating by the analysts that work on the project. And then we look at some other multilaterals, like I said, like IFAD and others. And then we discovered something really strange. And this will shock some of you. This is very controversial and it's ongoing work. Luckily, FDL was very kind to publish a provisional version of the report. And what we discovered was that a very significant number of projects, highly rated projects, simply don't exist. So there was like a $200-something million e-transform project in Ghana that is supposed to transform the ICT capacity of the country. And within that project, a number of really fascinating elements. An example being an automated electronic gate system for the airport, and to try and change our entire immigration system and embed it within an ICT strategy. Well, the e-gates, for which the World Bank has paid about $20 million and it has gone in for many years, simply is not in the airport. And there are a lot of projects like that, some of them climate linked as well for flood drains. When we began to investigate, what we discovered was that in actual fact, there is no mechanism for addressing this because in the World Bank projects, they exist. The actual official documents, they have been rated, they've been, gone through all the motions. So this is not some kind of stereotypical corruption problem or, that kind of thing, investigative journalists uncover corruption and a cover up. It's really something broken within the systemic rating system whereby projects that are having challenges because of the different actors involved in the fragmentation of how you report and how you design, etc., things fall through the cracks. And so it could well be that these projects, have been misdesigned and somebody is still working on them. But as far back as 2014, we'd recorded that we have e-gates in the international airport in Ghana. And as far back as 2018, we reported that we had a national road safety center that enables someone to call a road safety emergency hotline, get advice and report, etc., etc. But these things don't exist. But in the official rated document, so you can't really report them because the bank acknowledges that they've been done. So we said, look, if this continues and this system is not fixed, and you kind of pile a whole bunch of climate instruments on them, we're going to get reputational blowback. Essentially, we're going to get a whole bunch of the famous example of the Mount Elgon program in Kenya, in Uganda, where you have these fragmentation of reporting and things like that leads to investors, because the public, begin to, they think it's greenwashing, even though it may not be in design. Yes. What will then happen is that the volatility and the volume dynamics will lead to underpricing of these options, and will collapse that market. So the question is, what do we do about them? We think it requires a new way of doing monitoring, evaluation, and verification that involves local communities embedded in the process, because they are not going to miss it. If you tell me that, you're doing this road, like a performance-based contracting model that the World Bank is promoting now, and it requires user satisfaction and local communities are involved, I don't see how, if we can't see the road, that is going to be missed, right? Or the drain hasn't been done, that's going to be missed. So the fact that today, project ratings by most multilaterals do not involve a bottom-up element is, I think, completely unacceptable. In an age of social media, the technologies are available, the mechanisms are available, etc.
And I must say that this exact problem has driven last year when the climate finance, this report that was published today,
Yes.
saying that at last we reached above 100 billion. Last year, I don't know if you remember, FT and global media were all over the place saying, okay, we look at the list and can you explain us what you are funding? Because you say it's climate and we don't see the value. And it goes in the same direction that we know from the ground that the investment needs are massive. We know from the ground that we need adaptation mechanisms. We know from the ground that there are still a lot of governments trying to fund very good projects. But the way the international system, the way the MDBs, the way the public and private actors
It's an accountability
do organize themselves can lead, because of also a poor reporting system, to things that are counterproductive, as you said, and nurturing a debate that then become political, that enters our parliament, saying, why are we doing this? Why we, the taxpayers of France, we are funding things which seems crap. So I think here at the accountability level, what you say on, yes, we can do sustainability link, we can do climate link, we can do social link, provided it exists, provided it's well rated. Because if we say that we have more money at a lower cost, we need, as you said, to see the externality.
Absolutely.
So perfect transition to your neighbor. Because Jim is in charge of a number of sustainability-linked bonds emission, including the one in Chile, if I remember well. You also linked to a number of debt for nature swaps, which is another innovative instrument that with IDB in Galapagos, in other places now, Uruguay, I think, also has one, and Barbados. How we can transform debt into a climate positive investment instrument, and how we can exactly go on the places where Bright was leading us.
Yeah, I think from my perspective, and I tend to work more with the private sector and how to persuade them that debt pause clauses is a good thing, that sustainability-linked bonds are good things. And I think one of the earlier discussions I had on sustainability-linked bonds or KPI bonds before Chile, before Uruguay, was that, well, the thing with the traditional use of proceeds green bonds is that they're not holistic. So you could say, oh, I'll go build a windmill, but people could be dying on the streets under the windmill, using your example from earlier. So then people started thinking, well, sustainability-linked bonds, that's using a KPI, that's actually more holistic, right? Because you're saying that we want you to cut emissions, we want you to transition to using more renewable energy, which was what Chile did. That's avoids the problem of greenwashing. I think that's one issue. And then it's quite clear, what the monitoring, reporting, verification processes are, which goes to your point. But I think that brings up a bigger point that actually links to Kenya, because I remember I was in Nairobi at the end of last year talking about debt.
One of the debt consultants.
I was talking to a room full of 60 debt managers. I think several of us in this room were in the same conference, just doing capacity building and education. I talked about state contingent debt instruments, and I talked about natural disaster clauses, so debt pause clauses. And I just had so many people come up to me after that and just say why don't I know about these things, right? And in this room, we think that it's pretty mainstream that we know about these things, but there are debt managers out there who do not know what they are. There are people who are struggling with how to come up with sustainability-linked bonds that work for them. And the problem with that is that historically, if you're advising the government from a financing point of view, you're just talking to the Ministry of Finance, right? Once you bring climate in, when we did the debt for nature swap, when we did sustainability-linked bonds, you're going to talk to Ministry of Environment, Ministry of Foreign Affairs, and the list goes on. It's hard to herd cats, right? It takes a lot of effort and also in certain cases patience to deal with that. And on your question about debt swaps, this is just going to be a summary of the first session we had earlier today. The question about debt swaps revolves around whether it's suited for everyone. Avi and we talked about this right before this session. It's not the panacea, but it's an important part of the toolkit, right? And so far, in terms of debt swaps 2.0 or commercial debt swaps that we've done. There are only like 4 of them out there. It's not enough, right? We need to scale up, right? So we need to scale it so that, our liquidity premium, goes down. We need to scale up so that it becomes more transparent and more standardized. And we need to scale up so that, all the good things can happen and it can catalyze, other sovereigns to the transaction costs go down, which is one of the issues that people raise. And I think, the TNC, for example, is doing like good work in that area, and we need to continue to push that.
And debt financial swap has this beauty of normally reducing debt and include rebuying debt, so reprofiling debt, reducing the burden of debt at a given moment. I would sometimes the way you restructure, but also you have more capacity to invest. So back to our Kenya example, a debt for nature swap could become a way to have more capacity to invest. Yes, Avinash, I see you want to speak. I want to pass the baton to Vera.
Yes, but very quickly and there are multiple types of debt swap ideas. If you look at the ones that have been actually been used, essentially, it does not really save you much in terms of debt service or debt levels. What it does is it allows you to redirect that thing you were paying interest on onto something you weren't doing before, marine conservation. But if you've got so it's basically only appropriate for countries that have a chunk of high yielding debt, which the lower interest rates will help, but not a lot of high yielding debt, because if they do, then what they need to do is debt restructure, not debt swap. Yeah. And debt swapping before you restructure, if you have to restructure, is not helpful.
Yes, so we narrowed down indeed the number of situations where it makes sense. Then turning to Vera, everything we've been speaking here needs private people to put money on the table, both for sovereign, for projects, for semi-sovereign with the backing of an MDB. But at the end, you need a private person with savings to say, I want to put money in Kenya, or I want to put money in Ghana. And then come the appetite for risk, come the issue of financial regulation on how an asset from Kenya, from Ghana, from an emerging country is considered by supervisors, including when you have a public guarantee, including when you have a MEGA guarantee, including when you have a first loss insurance tranche. And today, and it's a work we've been doing with Vera and a few of us in the room, I will see some familiar faces, we realize that we are not consistent. That on the one hand, we have these discussions. We say, how can we share the risk differently? Because all what we've been discussing is a way to share risks. But at the same time, the financial regulation that was drafted after the 2008 global financial crisis is not aware of what we've been discussing here. It was drafted before the Paris Agreement. It was drafted before we were having all this discussion on blended finance, risk sharing, risk mitigation, and so on. So if we look at the actual implementation consequences of things that were not intended at the moment they were drafted, we see that institutional investors from OECD countries have now reached an historic low point in terms of exposure to emerging and developing economies outside China. So not only we have this net inflow problem turn negative, but the reason for this is that private institutional investors are investing less and less in emerging and developing economies outside China. And part of the explanation comes from the financial regulation. So Vera, with this introduction, maybe you want to explain what you've been doing in the recent months on the reform you suggest to unlock climate-related private investments in emerging markets.
Thank you. Thank you very much, Amélie. Good to see you again, and thank you for continuing the conversation also on the finance side, and good to see everybody on the panel. Bright, Avinash, everybody. And very interesting conversation. So I think maybe just to make 3 points in some sense to bring a little bit what has been said before and what I'm going to say to the fore. So if just numbers we have sort of 60 of the biggest banks in the world today spent about $705 billion in 2023, financing sort of fossil fuel type activities. about 58% of the loan book of many of these institutions was spent also financing fossil fuel type activities. So there are a lot of resources still going in some sense to the wrong side of the planetary preservation book. And so the conversation on the private sector side, when sometimes we say we need, the Songwe Stern report with Amar Bhattacharya says that we need $2.4 trillion to be spent annually to be able to, reverse the climate crisis that we are in. And people say, but, where are the resources going to come from? A lot of those resources are being spent today in the private sector, but on the wrong side of the balance sheet. And we need to see how we can reverse that. The good news is that actually, and I'm just doing some work now on sort of, the top 13 largest banks in the world. And actually, they have been doing sustainability-linked bonds with the private sector. And almost about $30 billion worth of sustainability-linked bonds are happening in the private sector space, not in our space. And so now to go to your question and why this is important, that the private sector is doing some things, but they're not doing it in the development environment. And that is because some of it for good reason. Let me start by saying, as Amélie said, in 2008, after the financial crisis, as all of us remember, there was a lot of talk about sort of the looseness of the financial system and the need for the financial system to have better regulation. And so we went into a phase where we had to re-strengthen and re-tighten prudential regulation, Basel III. A lot more was put in place for ensuring sort of Pillar 1 in particular, the liquidity framework, to make sure that, there was enough of a buffer so that we could prevent crises. It has worked, I hasten to say, because, we saw post-COVID, post-tightening, even though we found, a couple of banks went into distress, the system did not collapse, which means that, some of the prudential rules that were put in place worked. However, the prudential rules, and this is the conversation everywhere, when they were put in place, a lot of the emerging markets and developing economies were not in the room. And so some of the provisions are hurting us. And one of them, which is quite interesting and painful, is that while we talk a lot and we're very excited, and Avinash, we all work together with Amélie, by the way, on sort of pushing guarantees, for example, and I'll start with that. And we think that guarantees are such a fantastic tool because it's 1 to 4, and for $1, you can raise $4 if you use a guarantee. Guarantees in the Basel framework are looked at as a derivative product. And if we all remember, 2008 was all about derivative products that created the housing crisis. So the use of guarantees is penalized for good reason if you're looking at the private sector, if you're looking at sort of past behavior. However, we are using guarantees in the development space with MDBs as a way actually of reducing risk. So on the one hand, Basel looks at guarantees as a higher risk tool. On the other hand, development institutions look at it as a lower risk tool. The private sector in between, the private banks, now shy away from coming to take our guarantees, because if they use our guarantees, the liquidity ratio coverage that they have to put aside for using those guarantees becomes higher. So in some sense, we have written the right rules, but maybe for the wrong people. And so one of the things that we're working to do is to say, can we maybe segment now the private sector, maybe even the insurance markets, because a lot of the blended finance instruments came when insurance markets started developing. Can we separate insurance markets, the banking sector, and the multilateral development system, and maybe have different capital requirements for this different segments of the market? I think this is a very, very important issue, because when you talk to a lot of the MDBs, they'll say, but we put guarantees, but nobody came. Nobody came because if you come, then your reserve requirements, your liquidity coverage ratios become much, much higher. There's something called high quality liquid assets that you have to have. Of course, in a lot of emerging market economies, we don't have that many high quality liquid assets to put aside. So what has eventually happened is also that a lot of the financial sector has exited the emerging markets because they cannot meet a lot of the rules that have been put in place. And this is something that we really need to talk about. The other thing is that post-2008, so all of this happened post-2008, of course, the world was collapsing. We needed to put a floor on it. And so a lot of the regulation was done to see what caused it, how can we stop it? And so there were jurisdictions, and France was one of the leaders, where, you know, there was sort of a lot of sort of fiscal evasion, right? And so we created sort of know your client conditions, but we also then sort of made trade financing a lot more difficult. So trade financing for developing countries, where trade financing is particularly important because that's a lot of how, you know, a lot of the infrastructure projects work, also thinned out. Because again, trade financing, which is a short-term, high turnover financing, was regarded as even more risky. And so banks stopped doing that. Now, Basel is coming back to relook at that provision and it's fixing it. There were provisions around geography. So if you're, as Avinash knows, if you're sort of investing in a solar project in India and the same solar project in Indiana, your liquidity coverage requirements were very different just for geography reasons. So you needed to change that. And so there are all these little pieces of regulation where, even though we say that we're going to put resources in the MDB so that they can leverage the private sector, we are creating on the prudential side, and for good reason, as I say, because we want to protect the stability of the financial system. If it goes down, we all go down with it. So we need to protect it. But we don't need to protect it with one size fits all. I think this is the argument that we're trying to make, is that we can protect it with some differentiation. We can protect it with, you know, MDBs, understanding that MDBs, their role is to de-risk, to provide first loss. And the instruments that they are providing, even though some of them may be derivative instruments, are actually instruments that are shoring up the project, that are shoring up the institutions that are trying to do that, and not weakening them even further in terms of the stability of those instruments. But to make sure that on the other side, in the private sector side, we keep, you know, the requirements that are in place today, because we have seen that in 2002, 2003, they actually worked and the system was more robust. So I think that's one thing. The second thing is, or in terms of sort of the framework, the third thing that I want to say is the private sector is actually already doing a lot of risk, climate risk management. And I think that one of the things that we say in the report is there needs to be a lot more conversation between the private sector and the multilateral development system to see actually how we can make sure that we use the tools that are available better. And I fully agree with Avinash that in some sense, we're talking a lot more about debt swaps as opposed to the kinds of credit financing instruments that will actually deliver better climate policies and growth, and stop this reversal of capital from flowing from, you know, emerging market economies into the developed economies. 68 billion is the number. Today, $68 billion worth of resources are flowing from emerging market economies into advanced economies. With this kind of reverse flow, we will not get the development we need. But we must go back to, part of it is the prudential regulation. If we can fix this prudential regulation, we will continue to see the outflow. But the other thing is that countries need to develop robust, you know, growth and climate-infused growth plans so that capital can flow in the right direction. And I think this is a lot around sort of the country-owned plans, country-dependent plans that we need to put in place to make sure that that works. So it's, first of all, the private sector has the resources, $705 billion in 2023 going just to fossil fuels, about $1.3 trillion going into all of what we will consider not the right financing. So we can reverse that. We can change it and put it in the right place. Prudential regulation needs to be improved so that resources are actually flowing to where they need, with instruments that are differentiated. We need prudential regulation to protect the stability of the system, but we can differentiate that. And finally, countries must own some of the efforts that they do and put in place plans that are robust and create some fiscal space for themselves.
Exactly how we are trying to reach the Paris. And the second thing is that it's becoming a G20 discussion, because as part of the Brazilian G20 task force for climate financing, exactly the agenda Vera described, on one, country platforms, and two, financial regulation alignment with the goals we are setting, are on the table of the Finance G20 meeting at the end of July. This is at the heart of the International Financial Architecture Working Group. And I must say that since last year, so in 1 year, we made this discussion, which I must say was seen as extremely exotic and sometimes a bit like coming from outside the planet's sphere. Very, very weird looking people at you saying, what are you talking about? We cannot disentangle Basel III. You see, we have managed Silicon Valley Bank and Credit Suisse. So it's working. I say, yes, it's working for Silicon Valley Bank and Credit Suisse, but it's not working for the rest of the planet. So it's not a deregulation agenda. And we have to be very clear on it, because if we frame it like this, it's dead. It will never fly. It's not a deregulation agenda. It's an adjustment agenda to look at the unintended consequences of a framework that, when it was drafted, had not foreseen that, number one, we need blended finance at scale in all kinds of mixed risk sharing types of instruments. And second, that it is now a global priority to mobilize private capital to go in places where not anybody else is going, and that the consequences of this framework is now putting us all in a situation which is difficult. So now it's time to reaction. I see that Avinash is moving on his chair
Yes.
and having a lot of things to say.
I don't even think you need to go in terms of the unintended consequences. The reality is we actually have a form of regulation that is not about good risk management. So what happened was, at the core of Basel was we began defining risk as volatility. Makes some sense for banks. They've got very short-term liquidity. But then the insurance and savings and pensions regulators adopted whole-scale banking regulation into savings regulation. And that has a huge penalty for long-term investments and investments that were hard for them to come up with the short-term volatility measure. And that penalized the very investments we need as a planet to reduce the bigger macro risks we have. And it doesn't make sense from an insurance, from a pension fund, from a savings perspective. What they need to do to reduce risk is not to reduce short-term volatility. They need to match their long-term assets with their long-term liabilities. And that's what these long-term renewable energy projects do. And my final point would be, I think the narrative of this idea that we need to somehow say to the private sector, we'll give you some added grants or added things for you to do an investment in this area because it's a good investment. I think that narrative won't work either. We're not going to get to where we want to get to with philanthropy. We're not going to get to where we want to with aid. We actually have to make it a good investment for developing countries in their green industrial strategy policy. And we need to then unblock all these artificial obstacles that are getting in the way of good investment.
So Avinash, one thing is exactly a line we have. If we think that we have a risk management-based regulation, then can somebody explain to me why you have geography-based parameters like OECD, non-OECD insolvency too? Because I can tell you, Turkey is OECD. Rating is very, very below many of the developing economies which are not at the OECD. If you take Colombia, OECD, and Uruguay, not OECD, the capital charge you put on an equity infrastructure investment is 25% for an OECD country and 49% for a non-OECD country. And it's not risk-based, because I can give you the list, show the rating by country, and there is no consistency. Why? Because the OECD is not anymore a club of developed-only countries. It's a political, it's a norm-based institution, which we are very welcoming. Now, Brazil, Argentina, Indonesia are all coming in. It's very good. But you cannot say that it's a risk-based framework. So again, back to the risk framing of this supervision, it is not true. So we don't indeed need to call for the unintended consequences. Maybe we just have to call to make the system consistent with what it claims to be. From Kenya, maybe. David, you heard us talking about many things. How do you, from the place you sit, value or do not value what we have been saying?
Okay, I think, let me see whether I can analyze this. I think the most immediate pain point for countries like Kenya, and I'd call some countries in the middle tier. That's the frontier, lower middle income up to somewhere before you get to the new OECD sort of countries, which is a whole lot of people. Right now is two things: market access and cost of debt, market debt specifically. Why? Because I want to finance this year 3.5% of GDP deficit. That's sort of my fiscal framework. For Kenya, that works out to about $5 billion. I want to do 50-50 domestic and 50 external. And of the 50 external, I want to do 50% private. Now, if you don't have that private 50%, which is about $1.5 billion gap, and that is just, so that plus the refinancing of existing, which is another $2.5 billion, about another $1 billion of private. So $2.5 to $3 billion. That's what I need from the private market. If that's not available, you're gonna go to either ODA, mostly multilateral, because Paris Club bilaterals very little. The only bilateral non-traditional lender who had lots of money is China, who's out of the mix. So if that's not available, you are left with multilateral. And for a country like Kenya, 2-3 years, and we are now reaching about 70% of our external debt, which is preferred creditor. So you are hitting the ceiling of how much preferred creditor debt you can take. If it's not multilateral, then it's domestic, which you can do, but you're crowding out the private sector. And the other thing you're doing domestically is you the spread, the currency spread that investors are asking for because of the fiscal kind of the debt sort of the situation is like 10%, and percentage points. And this is just transmission of the high global interest rates. So that's where we are. So the climate or the sort of fancy instruments are interesting. We talk about them, but they're really not going to move the needle at this point.
Because any sustainability-linked bond or a green bond is something you don't consider as a good way to raise money from external debt market? It
is not. It takes too long. They've got, they use the same, they've got take too long. Obviously, over time, I don't think the future is going to be like the past. So I don't think the Eurobond markets are going to come back because a lot of that was very much driven by yield hunting post-crisis. And you got the same. So in a sense, I mean, in the future clearly we have to find. But the future needs to start at some moment. Yeah, but as of now, because of the debt wall that we are facing, I'm saying right now, our pain point is, so when you get a guarantee, for example, when this is live, I've just come from the US, from our state visit there. And one of the things we were looking at discussing is sovereign guarantee, US sovereign guarantee, DFC and all of that. The question becomes, if you have a certain guarantee exposure, and for our case from the US, DFC is about $1 billion. $1 billion. Do you use it for credit enhancement to access the market? Or do you use it for for some sustainability linked or liability management type thing? Now, there is a lot of interest and sort of issuers or sort of sponsors of debt swaps of all types, nature, food, security, vaccines, children, so a lot of things. But the point is, the priority for us at the moment, as I said, is market access. So we'd rather use the guarantee, the preference.
To enhance your credit. Yes.
To enhance your credit.
And I quote here the Nairobi, Washington, there is a Biden-Ruto declaration, which is a very good reading for all of you because it's exactly linked to climate and debt debate. And it's mostly based on what we discussed in Paris last year. And President Ruto is, carrying the baton to many places exactly on this narrative. So I think it's quite powerful. Avinash, without a mic, nobody can listen to you. So you can take this one to try. We're in the risk space here.
Half of your 10 percentage point on the currency charge per year, when we look at the numbers, relates to capital charges that the banks have to pay.
Yes.
So if we can reduce those, we can make a significant impact on that.
Yes.
10%.
So if indeed we reduce the risk weight asset treatment of the debt coming from emerging markets, indeed, you can manage to reduce the yield. So it's a win-win situation. More banks taking on, less capital to be called, and less cost for emerging countries. Frederico.
It's okay. I just want to react to something that I think that one of the things about swaps is that they do tie up the money, and sometimes you just need budget support. You need to finance your budget. So I think that, something that, that you were mentioning at the beginning about how this needs to be, the choice of the countries and very much aligned with country systems. I think that that's also very important. And I think that in line of that, picking up on something that Vera said, having the kind of the growth story, the growth plans for the countries that need to be financed. I think that countries also need to have a good story to tell to the markets, in addition to having the fixing the plumbing in the back, which of course is essential, but then also coming to the market with a clear story, clear growth strategy that is going to attract the funds.
So at the OECD.
Now, I mean, if you look at our Kenya case again, even with strong multilateral support, very robust growth story, a very strong pipeline of FDI and investment, green investment, and all sorts of spaces, all of that. The real sort of, you can have all of that. And I think that's whatever. But still, the debt refinancing risk.
Yes.
So you can have all of that, but it doesn't solve your debt refinancing risk. There's a stock of debt that you need to refinance. And in our case, it's actually if you look at the amortization, it's the share of multilateral is actually gone up very, very quickly.
And also because in between the FDI comes and the moment it pays taxes to the Kenyan tax authority, there is a lag.
Yeah.
And you have to refinance your debt now. And so attracting and having a story for growth is good, but it doesn't solve the issue in the present.
A good growth story and even attract a strong pipeline of investments, green investments, FDI, it does not solve your fiscal, your sort of debt vulnerability. So the debt vulnerability issue is a risk
for the rest.
Your growth story.
Yes.
And you.
So Bright on from civil society think tank in Ghana. Yeah. What do you take from the discussion? Hope or despair?
That's putting me on the spot. No, the truth is, the way we see things is that there's an interesting and intriguing harmonization of content in the global debate about what has to be done. But that is a bit of a false harmony, because for us on the front line, if I can use that word, those of us in countries, activists, primarily in country, we tend to feel that there is a chasm between the way we frame the problem and the way that global activists and a few elite local activists that have global access to the debate frame the problem. And I'll give a very practical example. Earlier on, we said, the public sector must be the bedrock in terms of public sector financing that then unleashes private capacity. The problem is when you look at multilateral funding, let's just take the World Bank's portfolio for climate finance. One of the critical problems that you discover is disbursement. So you can have as much commitments as you can into the hundreds of billions of dollars. But then you look at specific projects, you look at the performance rate, and money is coming at the rate in a trickle. And sometimes it takes about 10 years before you disburse $100 million into a project. So you look at drain management in Accra, which has been, we're working on for 20 years to try and reduce the flooding rate in Accra as part of the adaptation mechanisms for climate change. And you think, okay, how much money actually comes out of the ports? You come against a range of governance problems that nobody talks about in the global debate about unlocking more money. So there's a lot of talk about all the engineering that will unlock money. And then when the money is unlocked at the commitment level, nobody is at the local level looking at disbursement because of this chasm between local civil society and global civil society. And I think that is creating a debate that, notwithstanding the harmony, is not leading to outcomes and transformation on the ground.
And it's leading to a lot of geopolitical tensions.
Exactly.
Because then you bring people at the G20 table and you don't understand, because there is a part of the table saying, we are putting a lot of money.
Yeah.
There are people saying, yes, we're investing a lot of money. And there are people saying, we don't see anything coming.
Yeah.
And this is the whole debate about the Global Green Fund and the Global Environmental Fund and all these funds all around, 70 of them.
Blue Basin Fund.
70 in the planet, where we, France, G7 and others, we have locked in capital and we don't understand why people scream at us saying it's not coming. And in fact, we now understand that we have scattered the money all around. We have fragmented the money all around. The schemes are not the same. And when you're in the shoes of David, you say, yeah, there are potential conceptual money somewhere, but to access it is so complicated. So it's a virtual money. But for us, again, in Parliament, it's not virtual.
Yeah.
It's a check we give every year. And then you nurture geopolitical tension and you nurture political backlash, because then ODA and other types of solidarity investment, as we call them, become very controversial in the countries that are paying, saying, well, people are not seeing the outcome. And they become very controversial from the governments, saying, well, the money you talk about is virtual. So we are indeed at the heart of a problem, because yes, there is harmony, but there is nothing effective, or not nothing. We should not be too negative.
Effective constriction.
We have a challenge of effectiveness. Jim, do you have any feedback?
Do we have time?
Maybe, yes.
No, I think, I hear what David was saying, because I hear that from other sovereign issuers as well, that you have so much to do, right? And if there's an obvious easy way to do it, great. But then we come up with something so complicated: debt swaps, sustainability-linked bonds, even natural disaster clauses. All these things, it takes up a lot of mental power, right? And people don't have the capacity to deal with it. The laptop is falling off the podium. Yep. Maybe it's our time to go.
This is good risk management and early warning system. Early warning system. You know that there are many countries paying lots of money for early warning system, and at the end it relies on human beings being awake. So it's very good.
So,
yes.
Vera have something to say?
Yes. So that is why the laptop was falling. Vera was leaning in.
Telekinesis.
Can you hear me? I think something happened. Mecca, something happened. Oh, I think you can hear me. No, I can't see you all, but maybe you can hear me. I get a chat saying go on, so I'm sure you can hear me. Yes, no, I just wanted to come back a little bit, maybe, and tie the conversation, since we are coming to the end. Work that I have done with Ishak, yourself, Amélie, Martin as well. I think goes directly to the heart a little bit of what the World Bank is saying, the country Kenya is saying, and Avinash, and how we could all pull it together. I think we're calling it the bridge proposal, and I think, Elizabeth, this is where you are in Kenya. It's not enough, I think, for the World Bank to give you the resources. It's what the markets are waiting for also is to see a good strategy, a credible strategy, but also looking at your disbursements to see whether that strategy, which is credible, will actually be implemented. because it's only the implementation of the strategy that then delivers the rate of return on the resources that you're going to get to pay back the resources of the private sector. And so we're saying, you know, if bilaterals can come in, but in Kenya, you don't have that many bilaterals. Bilaterals can come in, of course, and on the kind of debt service suspension initiative, you know, help you to extend your maturities for some of the loans you have on the bilateral side, maybe with China and others, you know, but then you put in place a credible investment plan which begins to deliver some fiscal policy. The World Bank puts resources behind you, which is essentially what happened before you went to the market at 17%, it was shut out. When you got resources from the World Bank and the IMF, it was 10. And so you could actually go to the market. But it was 10 because I think, you know, your disbursement rates were slow. One is not seeing the rate of return on the investments that will deliver quickly for you to be able to pay back the investors. So your predicament, I think, on the guarantees is a real one. But maybe one of the things you want to do is say, okay, the guarantee in some sense is coming from the US or whoever, saying we're guaranteeing that this country's growth plan is actually going to deliver. But for that growth plan to deliver, I think you have to begin to, and there are some reforms that do not take 3 months to or 7 months, right? Some reforms are just policy changes that begin to show the direction of travel. And I think if you could put in place a few policy changes that show, you know, a concrete direction of travel, immediately you begin to get the markets, because I think we always sort of see the markets as the bad person here. But every time you talk to the markets, and I'm closing, the markets actually want you to come. That is their business. Their business is to finance you. But they can only finance you to the level at which they think they're comfortable enough that you will be able to pay back. And so this proposal that Ishak and Martin and myself have put together, we hope that we can bring you, Kenya, to come and see how we can talk about it and move forward, maybe testing a little bit the World Bank more, but also, you know, showing the markets that we can actually present a case that shows good, you know, growth strategy, green growth strategy, good World Bank, IMF federated MDB financing in an environment that allows the private sector to reduce its cost of borrowing and make it more affordable for you. Thank you.
Thank you, Vera, for having put back this triple agenda, the triple deal on the table, that we will not solve the Kenya-type situations without indeed a very strong ownership of a country platform plan, a very strong commitment of the multilateral system to provide the instruments and the funding you need, and a commitment for the private sector to understand that if the debt is not potentially restructured or having some clauses or having some rates which are lower, at the end, it's not sustainable. So we are just pushing back a problem, as you said, that will be repeated, that now you're reducing maturity, you increase the cost. So we see the need to have a more structural joint approach to make your case on the management system more manageable. Yes, sure. And then maybe I would take one question for the public. So think about your, no question from the public, because some want to leave, some do not want. I've been asked to maybe have one question, but yeah.
I want to make a distinction between the markets, the financial markets, and private investment and investment generally.
Yes.
We have a very strong private investment pipeline. Kenya was named by FT Intelligence as number 2 on 3 prospect for FDI in 2024. I am sitting on a pipeline of just infrastructure PPPs of about $15 billion of inward investment.
So people interested by Kenya, they're not interested by Kenya debt.
Yeah, becoming yes.
Fiscal.
So we don't have a growth problem. We have accelerating growth. I think the last 4 quarters, we are now, I think, approaching 6% growth. We have low inflation, or sort of is fine. The problem is the debt overhang.
It's the cost of the legacy.
It's the cost of the legacy. And that's now the risk to the growth.
Yes.
Growth story, rather than that you don't have a growth, that you need a growth story. So there's a disconnect between how to resolve the legacy of the last 10 years, including the COVID and sort of aftershocks. And even when you have a growth story, and that's the point, the new instruments won't sort of happen fast enough,
Yes.
as you're saying, to be able to resolve the legacy, and the climate shocks
That
are still coming.
yes.
So that's the convergence between the climate shocks and the debt vulnerability is a very distinct thing from the economic prospects
Yes.
of the country and its policy framework. I think that's an important distinction that we need to make.
So as debt restructuring is a compromise story, I think we will end here because I see people willing to have their nights and evening program, but the speakers might stay for some minutes for the cocktail. So it will be the way for you in the room to also ask questions if you want. I thank you a lot, all of us, to have followed this discussion. I hope it was interesting. And I hope it was also thought-provoking for your future and current work. Many thanks, Vera. And many thanks for sharing with us a number of insights. Have a good evening to all of you.